October 1929. The Roaring Twenties ended not with a whimper, but with a scream that echoed for a decade. The stock market collapsed by 89%. It took 3 years to hit bottom. Unemployment hit 25%. It wasn't just numbers on a board. It was hunger. It was dust. It was a generation defined by the hollowness of their empty pockets. It took 25 years, a quarter of a century, for the market to return to the level it held on that one Tuesday in September 2008. The Great Recession, the housing market, the bedrock of the American dream, turned into quicksand. Stocks fell 57% in 18 months. Retirement accounts incinerated. Banks on their knees, begging for the public's money. It took 5 years to recover. We called it a once-in-a-lifetime crisis. We thought we had learned. We thought we had fixed the plumbing. But we were wrong. What is coming in 2025 is not 1929, and it is not 2008. It is both, combined and amplified. Financial historians are calling it the everything bubble. In every previous crash, there was a safe harbor. In 1929, you could buy bonds. In 2008, you could buy treasuries. But in 2025, stocks, bonds, and real estate are all crashing simultaneously. When everything crashes together, there is nowhere to hide. What if I told you that mathematically, we are standing in 1928 right now? The party is loud, the champagne is flowing, the tech stocks are soaring, but the doors are already locked. Except this time, the tools that saved us before do not exist. The Federal Reserve cannot cut interest rates to zero to save the market because they are already historically low relative to inflation. They cannot print unlimited money because they just did that, and it triggered the worst inflation crisis in 40 years. And the government cannot bail out the banks because the government itself is drowning in a $36 trillion ocean of debt. Let me show you the mechanics of the machine that is about to break. Let me show you why the crash window is mathematically projected between November 2025 and June 2026. This is not speculation. This is arithmetic, and the bill is coming due. To understand why this crash will be different from anything in your lifetime, you have to understand the unique structure of the trap we have built. We are not in one bubble. We are living inside 3 simultaneous, overlapping bubbles that have never coexisted in financial history. Bubble number 1, the stock market. Look at the S&P 500. It is currently trading at a price-to-earnings ratio of 28. For context, the historical average, the sanity line, is 15 to 17. We have only seen valuation extremes like this twice in American history. Once in 1929, days before the Great Depression began, and again in 2000, right before the dot-com crash evaporated 78% of the Nasdaq's value. Both times, the market didn't just correct. It imploded within months of hitting these levels. But the 2005 market has a fatal flaw that 1929 and 2000 did not have. Fragility through concentration. 7 companies, the Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla. They represent approximately 30% of the entire S&P 500. Think about that exposure. If these 7 companies sneeze, the global economy catches pneumonia. This level of concentration hasn't been seen since 1929, when a handful of industrial trusts held up the sky until they didn't. In 2000, the tech bubble was broad. Today, it is narrow, it is sharp, and it is terrifyingly fragile. Take Nvidia, the poster child of the current mania. It trades at a P/E ratio above 65. That means investors are paying $65 for every single dollar of profit the company generates today. Its market cap exceeds $3 trillion. It is worth more than the entire stock market of Germany, the 4th largest economy on earth. This isn't investing. This is a casino. It is speculation driven by artificial intelligence hype that mirrors the internet fever of 1999. Were they right about the internet changing the world? Yes. Were they right about the stock valuations in 1999? They were catastrophically wrong. The same script is playing out. Yeah, we'll change the world. But the bubble built on top of it is about to burst. Bubble number 2, real estate. If you think 2008 was the peak of housing insanity, look at the data. In November 2025, home prices are sitting approximately 50% above their long-term historical trend relative to income and rent. At the absolute peak of the 2008 bubble, the one that nearly destroyed capitalism, homes were 35% above trend. Do the math. The current bubble is 43% larger than the one that caused the Great Recession. We are walking on a tightrope over a canyon that is deeper than 2008. But because prices have been high for 3 years, we have normalized the insanity. We accept it. But residential real estate is only the fuse. The bomb is commercial real estate. This is a slow-motion car crash that everyone sees, but no one can stop. Office buildings across America sit 45% vacant. In San Francisco, vacancy is 35%. The remote work revolution didn't just change where we work. It destroyed the collateral of the banking system. These skyscrapers were financed with mortgages when rates were 3%. Now, those loans are coming due. They must be refinanced at 7, 8, or 9%. The buildings cannot pay that debt. They aren't worth enough. This leads to defaults, which leads to bank losses, which leads to a cascade of failures that mirrors the subprime crisis of 2008. But this time, the toxic assets aren't houses in suburban Florida. They are the skylines of our major cities. But stocks and real estate, we have seen those crash before. It is the third bubble that makes 2025 an extinction-level event. For wealth, bubble number 3, the bond market, government bonds, the bedrock, the risk-free return for 100 years. This was the golden rule of investing. When stocks crash, you run to bonds. In 1929, as the stock market vaporized, bonds held their value. In 2008, as Lehman Brothers collapsed, Treasury bonds rallied. They were the shield. But in 2025, the shield is made of paper, and the paper is burning. This time, bonds are crashing alongside stocks. Why? Because the United States government has issued so much debt that the global market simply cannot, or will not, absorb it anymore. Total federal debt has smashed through $36 trillion. That is approximately 125% of GDP. We have seen this ratio once before, at the end of World War II. But there is a critical difference. In 1945, America was the only factory left standing in a destroyed world. We grew our way out of the debt because we own the global economy. Today, we are competing with rising powers, struggling with demographics, and running on deficits. The annual interest payment on this debt, just the interest, not paying down a single dime of the principal, now exceeds $1.2 trillion per year. That is the single largest line item. In the federal budget, it is larger than the entire defense budget. It is larger than Social Security. When your credit card interest payment is bigger than your rent, you are bankrupt. You just haven't admitted it yet. The government is trapped in a trilemma of doom. They have 3 choices. 1. Cut spending drastically, result, immediate recession. 2. Raise taxes drastically, result, immediate recession. 3. Print money to pay the debt, result, hyperinflation. There is no fourth option. There is no magic door. This is the everything bubble. Stocks priced for perfection, real estate priced for fantasy, and bonds, the safety net, collapsing under the weight of math. The parallels between now and 1929 are so precise, it feels less like history and more like a script we are forced to reenact. Let's look at the eerie reflections. The valuation mirror. In 1929, the P/E ratio of the Dow Jones hit 33. Unprecedented, they said. In 2025, the S&P 500 sits at 28. We are staring at the same cliff. The narrative mirror. In 1929, the public was intoxicated by new technology. Electricity, radio, automobiles. They said, this time is different. The old rules of valuation don't apply to the radio age. In 2025, replace radio with artificial intelligence. That changes everything. They say, valuation doesn't matter. The technology was real then, and it is real now. But the bubble attached to it, that is a delusion. The leverage mirror. In 1929, margin debt, money borrowed to buy stocks, hit record highs. Shoe shine boys were leveraging their tips to buy RCA stock. In 2025, margin debt is high, but the hidden leverage is worse. Retail investors buying ODTE options. People using credit cards with 25% interest to buy NVIDIA stock. Corporations borrowing billions to buy back their own shares. The system is leveraged to the hilt. It is a tower of glass waiting for a stone. The inequality mirror. In 1929, the top 1% held about 25% of the income. When the rich stopped spending, the economy froze. In 2025, the top 1% controls 32% of total wealth. We are more unequal than the Great Gatsby era. The entire economy depends on the spending of the top 10%. If their portfolios crash, consumer demand evaporates overnight. But here is the twist. Here is why 2025 is actually worse than 1929. In 1929, the stock market was a club for the elite. Only about 10% of American households owned stock. When the market crashed, 90% of people looked on in horror, but their savings weren't directly in the ticker tape. They suffered later from the economic fallout. In 2025, 58% of American households own stock through 401ks, through IRAs, through pension funds. We have financialized the entire population. When the market crashes this time, it doesn't just hurt the tycoons. It obliterates the retirement savings of the nurse, the truck driver, the teacher. There is no insulation. There's no buffer. The pain will be immediate, and it will be universal. And what about the banks? In 1929, banks failed because there was no insurance. If the bank closed, your money was gone. In 2025, we are told, don't worry, we have the FDIC. Your deposits are insured up to $250,000. It sounds comforting until you look at the balance sheet. The FDIC has about $125 billion in its insurance fund. It insures approximately $10 trillion in deposits. That is a coverage ratio of roughly 1% to 5%. If one or two small banks fail, the system works. But if we have a systemic crisis, if multiple large banks fail simultaneously, the FDIC fund is a drop of water trying to put out a forest fire. To make depositors whole, the government would have to print trillions of dollars instantly. And that leads us back to the poison pill, inflation. Either you lose your money because the bank fails, or you keep your money, but it becomes worthless because they printed too much of it. Pick your poison. And the Federal Reserve, the supposed guardians of the economy? In 1929, the Fed was young. They had room to act. In 2025, the Fed has spent the last 15 years burning its credibility and its ammunition. They inflated the bubble with quantitative easing. They kept rates too low for too long. Then they panic hiked rates in 2022, breaking the bond market. They have lost control. But more importantly, they have lost the tools to fix what is coming next. To understand the mechanics of the coming collapse, we must look at the ghost of 2008. But we need to realize 2008 was a localized infection. 2025 is widespread sepsis. In 2008, the toxic asset was subprime mortgages, loans given to people with no income, no jobs, no assets. These were packaged into securities and hidden in bank vaults. In 2025, subprime is everywhere. We just changed the name. Look at the auto loan market. We have normalized 84-month loan terms, 7 years of debt for a depreciating asset. We are seeing record defaults among borrowers with poor credit. Look at credit cards. Debt has smashed records, with average interest rates exceeding 21%. Look at student loans, $1.77 trillion that will effectively never be repaid. Look at corporate debt. It has quintupled from $2 trillion in 2008 to over $10 trillion today. Companies didn't use that debt to build factories or innovate. They used it to buy back their own stock, artificially inflating the bubble. In 2008, leverage was concentrated in housing. Lehman Brothers was leveraged 30-1. A 3% drop in asset values wiped them out. In 2025, the leverage is in the derivatives market. The notional value of global derivatives now exceeds $600 trillion. That is 10 times the GDP of the entire planet. It is a spider web of bets on interest rates, currency fluctuations, and credit defaults. If one thread snaps, the whole web collapses. And here is the terrifying difference. In 2008, when the fire started, the Federal Reserve had a fire hose. Interest rates were at 5.5%. This gave them plenty of room to cut rates all the way to zero. This stimulated borrowing. It cushioned the fall. They also had a clean balance sheet. They could launch quantitative easing, printing money to buy bonds without immediate consequence. They took their balance sheet from $800 billion to $4 trillion. It was an unprecedented experiment. It saved the system by creating the very bubbles we face today. But in 2025, the fire hose is dry. Interest rates are relatively low compared to history. If the Fed cuts rates to zero now, they risk reigniting the inflation fire that is still smoldering from 2022. And quantitative easing? The Fed's balance sheet is already bloated at over $7 trillion. They cannot print their way out of this without turning the dollar into confetti. The 2021 inflation surge, 9% CPI, taught the world a lesson. You cannot print wealth. You only print inflation. The Fed is trapped in a box of its own making. Print money, destroy the dollar. Don't print, allow a Great Depression. And the government? In 2008, the debt-to-GDP ratio was a manageable 67%. We could afford a $700 billion bailout TARP. We could afford to save GM and Chrysler today. With debt at 125% of GDP, where does the money come from? There is no spare $1 trillion lying around to bail out the next Lehman Brothers. If the government tries to borrow it, the bond market will revolt, sending interest rates to the moon. The bailout option, the safety net that saved capitalism in 2008, is gone. Even the international cavalry is missing. In 2008, China was a rising giant. Their massive stimulus package pulled the global economy out of the mud. Europe was stable. The G20 worked together. In 2025, China is in the middle of its own economic nightmare of $13 trillion local debt crisis. And a collapsing property sector. Europe is fractured by energy crises and stagnation. Geopolitics is a minefield. There will be no coordinated global rescue. Every nation will be fighting for its own survival. So, when does it break? The most reliable predictor of recession in the last 70 years is the inverted yield curve. When short-term rates are higher than long-term rates, it means the market is broken. This indicator has predicted every recession since 1950. No false positives. The curve inverted in July 2022. It stayed inverted for 27 months. It finally normalized in September 2024. Here is the catch that traps the amateurs. The recession doesn't happen while the curve is inverted. It happens 3 to 12 months after it normalizes. That puts the danger zone exactly where we are now, October 2024 through September 2025. The alarm has been ringing for 2 years. Now, the timer is hitting zero. Consumer debt is the canary in the coal mine. Credit card debt, $1.14 trillion, an all-time record. Delinquencies are rising to 2011 levels. The American consumer, who drives 68% of the economy, is tapped out. They are maxed out. They are drowning. And behind the consumer, the commercial giants are starting to stumble. The $1 trillion in commercial mortgages must be refinanced in 2025 and 2026. Remember, these loans were born at 3%. They are being reborn at 8%. The math is impossible. Brookfield defaults. Blackstone limits withdrawals. These are the smartest guys in the room, and they are walking away from the table. When the giants fall, the earth shakes, and the regional banks standing in their shadow are about to be crushed. Regional bank failures in 2023 were not a one-off event. They were the tremors before the earthquake. Silicon Valley Bank, Signature Bank, First Republic. They failed when the economy was growing. What happens when the economy contracts? When commercial real estate defaults surge in 2025, dozens, perhaps hundreds, of regional banks will face insolvency. The FDIC fund will evaporate in weeks. The panic will not be contained to Silicon Valley. It will be on Main Street. But the trigger, the spark that lights the fuse, might come from the top. The Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla. 30% of the S&P 500. Nvidia alone, 7% of the index, is trading on hopes, dreams, and a P/E ratio of 65. If Nvidia misses earnings, if the AI hype cools even by 10%, the stock could drop 50% in weeks, and because of the concentration, it drags everything down. Algo trading bots will sell the index. Margin calls will trigger forced liquidation. In 1929, margin calls turned a correction into a crash. In 2025, with margin debt at historic highs, the selling will be mechanical, merciless, instant. Institutional risk models, the automated systems managing trillions for pension funds, have sell triggers. When the market drops 20%, they must sell to preserve capital. This creates a doom loop of selling beginning selling. Within the first month, we could see stocks down 30 to 40%, and then the cascade moves to bonds. Investors flee stocks for safety. But the government is issuing trillions in new debt to cover the crisis. Supply overwhelms demand. Bond prices crash. Interest rates spike. The doom loop is complete. Then housing. Buyers disappear. Sellers refuse to cut prices until they are forced to. Within a year, home prices in overheated markets Austin, Phoenix, Florida could drop 40 to 50%. Millions of Americans will be underwater, owing more than their home is worth. Then employment. Tech bloat meets economic reality. Layoffs won't be in the thousands. They will be in the millions. Unemployment could spike from 4% to 10%, then 15%. For the average American, this is not just a chart. It is a 401k dropping from $600,000 to $200. Zero. It is a retirement delayed by 15 years. It is an entire generation of college graduates entering a workforce that has hung a closed sign on the door. In 2008, we recovered in 5 years. In 1990, Japan crashed. It took them 34 years until 2024 to recover their stock market highs. An entire generation lost. That is the risk for America. A lost decade or two. Why is 2025 worse than 1929 and 2008 combined? Because we have combined the asset bubbles of 1929 with the debt bubbles of 2008 and added a sovereign debt crisis that we have never seen before. In 1929, only stocks crashed. In 2008, only housing crashed. In 2025, everything crashes, and the toolbox is empty. The Fed cannot cut rates to zero. The Fed cannot print without hyperinflation. The government cannot borrow to bail us out. The warning signs are not predictions. They are current events. The yield curve has spoken. Buffett is hoarding $325 billion in cash. Insider selling is at record highs. Gold is hitting record highs as central banks flee the dollar. The window is open. The data points to November 2025 through mid-2026. This is not fear-mongering. This is pattern recognition, the mathematics of unpayable debt, overvalued assets, and exhaustive policy guarantee a correction. Nature abhors a vacuum, and markets abhor a bubble. The correction is coming. The everything bubble will become the everything crash. The only question left is not if. It is not even when. It is. Will you be prepared when it arrives?